Hi, I am Ed Butowsky. Welcome to another segment of IVoT Eye on Investing. We are joined today by Andrew Tang, Chief Investment Officer, Turner Financial Group, and Emile Westergaard, Founder and CEO of IVoT Financial Training. Today, we're going to be discussing the market with Andrew, and then we're going to follow that up with a very detailed analysis by Emile on Nike. So, Andrew, thank you very much for joining us today.
Well, thank you for having me. We are definitely going through some tumultuous time right now. The markets are reacting to the chaotic way of the current administration is handling the tariffs. How is it presented? And how is it that it's going to ultimately affect the whole economy? So from the very simple way to look at it, we understand what the intentions are from the current administrations. But the way that Mr. Trump or the President Trump is handling it, I don't think everybody agrees on it. So we can see that the effort for other countries to come and on their own terms and on their own time to negotiate with the White House is the strategy, and we have seen some results, and we have seen some announcements from various countries. I believe the latest numbers is somewhere around 50 countries have already spoken to the White House representatives and started the negotiation process. But the real question is this enough? So far, we are seeing a rebound from the markets. And I would say it is a function of looking at the fear and greed index that this is historic times, because the fear and greed is as low as 4 out of 100 at extreme greed. And if you can recall, the last time the fear and greed had hit 4 single digits, it goes all the way back to 2022. That's when the Federal Reserve raised interest rates from 0.5% to roughly somewhere around 4.5%. So these are the times that is reflecting that we are in a deep recession. However, we are not in there yet. These are all working on the basis on sentiments. However, if the tariff position does not improve soon, the supply chain effect can really take a toll on the economy. And here's the reason why. There's not enough time for the United States to produce the parts that are going to be the component of a finished good, or even for a sub-finished good, right? So if it takes time, and it's going to take time, to move that operation to the U.S., then we need to have room for negotiation, and we need to have a longer period of time for these plans to be executed. And right now, we are starting to get data that shippers are holding off the shipment to come to the U.S. because of the tariff issues. So I'm looking forward to hear improvements from this front. If not, the result could be disastrous, because if the shipments continue to stop coming to the U.S., then a manufacturing plant can actually shut down, okay? If, Elon said it very, very specifically, that one small part can actually take down the whole shipping manufacturing operations. And so if that does happen, then, we can get into a situation of furlough, and we can get into a situation that the factories need to temporarily lay off workers, and so on and so on. So we don't want that to happen. And in the case if that does happen, the market, of course, can drop further. But outside of that, I look back to, go ahead, Emile.
I didn't mean to interrupt, but I questioned, given that we do not have the manufacturing capability nor the skilled labor to do it compared to China or some of these other countries, for example, was there ever really the expectation that this would all move back to the U.S.? Or, because I don't even see that was even possible to begin with.
Well, to answer that, it's two-pronged. So basically, if we look at the current manufacturing capacity in the U.S., it's somewhere around 60%. But obviously, it needs time to design and lay out and basically build the manufacturing facilities and then move the whole operation over. But I'll tell you, the new factories that are going to be built, it's not going to be too labor intensive. It's not going to be the old factories. It's going to be full of automation, hardware and software wise, right? However, it's just that we need time. And to rush through this and say, okay, I'm going to put a blanket tariff for 10, 25%. If that caused a delay in shipping for any components or parts to make the goods, then we could run into a situation that the factories can shut down. Like, for example, do you think Boeing is making planes now if any one of those components are not received? And if they run out on the existing inventory, that could be a real problem. So it is just a matter of time. We're going to start to see manufacturers are going to complain, to the current administration saying that, listen, we have no choice but to shut down the plant. But that's when, I don't think we're going to, lead to such disastrous situation. Hopefully we can resolve this quickly, and I'm talking about days, not weeks. Then I think we can avoid a further drop, in the market. But so far, it is reflecting that kind of scares and that kind of scenario.
So, Andrew, what sector do you think the supply chain is going to be most disruptive? Because you've explained it as well as anybody has up till now about the supply chain being messed up and how the United States is not at a position manufacturing wise and as Emile pointed out, labor wise to fix or to complement the supply chain that's going to be left behind. So which sectors do you think are going to be affected the most?
I think it's going to affect heavier manufacturing activities, industrial-wise, more complicated goods, meaning goods that have a lot more components. Now, it's very different. Obviously, Nike shoes are largely made in Vietnam because they made a big deal. Apparel, shirts, they're a little bit more simpler than, let's say, making a plane from Boeing. So I'm talking about durable goods, heavier goods, washing machines. I mean, do we really want the United States to make LED televisions or electronic components? I don't know. Maybe not all, okay? But for example, cars, autos, planes, other transportation devices and vehicles, these are the industries that's going to be hit the most. This is what I believe. The more complicated and the more parts that's needed for that finished good, the more that's going to be affected.
Well, and I mean, but for the simpler things that might have a higher labor component, though, then the cost of labor in our country is so much higher than it is in a lot of these other countries where things are being made. So, I mean, I'm assuming Nike's just going to have to eat the tariff and continue to make stuff in Vietnam. They're not going to be able to move their manufacturing to the U.S. They can't pay people benefits and $15 an hour, whatever. They're not paying that in Vietnam, I would assume. No.
Well, there are two scenarios under that assumptions. Okay, so one is that the manufacturing activities the facilities is going to be largely automated. And the reason why, for example, these robot arms, the single arm for these robots in the manufacturers' facilities, they used to cost tens and thousands of dollars. Now the cost of such a robot has come down to the single thousands dollars. So we can see that both hardware and software that's in the automation field, the cost curve has come down dramatically. Yes, it has. But I believe the negotiation is going to be two-part. One is going to be a promise to make an effort to make the most component in the U.S. or the finished assembly in the U.S. But the parts and sourcing the raw material, hey, that really sometimes need to be from the outside of the country because we just don't have those things. And we don't have it from day one. That's the most important thing. the president wants everything done on the day one, and it's very difficult to do that, and it frustrates a lot of people. And I see it in many people's eyes that they're frustrated, but they are patriots, and they understand that they want fair trade, and they want to support the current administration any way they can. But the situation, it is so tricky that I beg the current administration to basically to extend more time so that they can finesse this, and figure out this problem. Because it is a complex problem. It is not as simple as the board that was presented in the Rose Garden.
Very, very detailed and very instinctive on your part, Andrew. I appreciate it. I hope everyone watching really cherishes your knowledge, because I do. So what about the bond market? We see interest rates have not gone up. We've seen interest rates come down. What's the reason for that?
Yeah. Well, I tell you, because we're entering the biggest auction for treasuries in the coming days, okay? I believe this spike, the very recent spike in the long-term rates, is a reflection of the anticipation of boycotting treasuries, okay? Because in the existing or prior to tariff days, other countries make money from U.S. imports, okay? And I know it's unfair, but in return, they buy our treasuries, okay? They support the treasury in return. There could be a possibility that the countries around the world that are affected by the tariffs, they say, hey, man, I don't feel like buying your treasuries right now. So I believe the recent spike is a function of that. Now, will it continue? Probably not, because most countries, they still look at USA as the number one, place to buy the debt or to put their money to work, because no country wants to buy their own debt, not like that, because it would just cause their currency to appreciate and increase in value, and then in turn it's going to cost their goods and services more expensive. So most countries, if they want to stimulate growth within their economy, they do want their currency to be less expensive and not very high. And that's why that's one of the items that the current president would like, is that lower currency, lower oil prices, lower yield, but we recently not getting that. But I believe this is also indirectly an arm wrestling match between President Trump and Jerome Powell. Basically, the current administration, specifically Mr. Trump, he wants interest rates to come down sooner. And yesterday, we just received news that the current market is pricing in 5 rate cuts now. Remember, before all this began, before the sell-off, the Fed was saying that we were going to have 2 rate cuts this year, right? Starting from June, operating under normal timelines. And then it became 3, became 4. And now, as of yesterday, the market priced in 5 rate cuts. Could it happen as soon as April? Maybe. We're waiting to see what will happen. But
Fantastic.
Never a dull moment, right?
So, Emile, let's take a little time and dive into Nike, because Nike is in the crosshairs of everything that's happening with the tariffs. And I think that you can do an incredible job of looking through and seeing the valuation of Nike and if it makes sense to buy it. And everything that you do is fundamental analysis. It's done on a long-term basis, not a short-term trading strategy.
Yeah, we want to understand what the company is worth as an owner of the company, and that's what we're going to take a look at for Nike. As you said, even before all of this, Nike has really been struggling for the last, year plus, and the stock has gotten destroyed. I mean, you're talking about, it reached a peak of 165 not that long ago, probably a year and a half ago, and now is sitting at $55 a share. So, not been a good journey for the last, year and a half, 2 years for investors. The question is, so that's obviously pre all this tariff stuff. And it's interesting. I mean, their recent quarter was a disaster. I mean, sales were down 10% around year over year. And, that's not tariff related yet. And also, interestingly enough, you look at Adidas as kind of their number one, competitor. Adidas grew sales in the last year 18%. So Adidas is on fire, on the other hand.
Yeah,
Though
there's a
Adidas,
lot of competition. Nike, they're Hoka. You see Hokas everywhere and on brand. So, and then obviously Adidas is doing well, and Reebok is coming forward. So why don't you take us through the analysis tool that IVoT is so famous for?
right, yeah. So what we want to know is with the stock at 55, we're buying ultimately as owners their cash flow, right? So what we want to do now is take a look at what the implied value of that cash flow stream is that you're owning as an owner of the company is as an owner of the company's shares on a long-term basis. You're a shareholder of the company. What you really own is your right to their cash flow stream. So let's just take a look at Nike, right? So in the most recent quarter, so here you go. This is called our IVoT forecaster. And by the way, I'll show you at the end of this how you can join IVoT. And we have a QR code in the link here in the video where you can join and learn more about these tools and how to access them and use them. But in this case, Nike's got 1.5 billion shares trading at 57 bucks, $85 billion market cap. Again, down. If I just look at the chart real quick, this is down in the last year 38%, and from a peak in 2021 it was trading at 168. So it's just been a real tough period. Now the question is, well, is it a bargain, right? Have people kind of thrown out the baby with the bathwater, whatever you want to say? They just did $824 million of cash flow in the fiscal third quarter of 2025 ended December, and that was down. I'm sorry, that's fiscal third quarter, I think ended, March. That's down 46% year over year. So the cash flow generation of this business is in a free fall. And we can look at, first of all, what that says, according to IVoT math, is the current cash flow stream is worth about 57 bucks a share, down from $101 a year ago. So literally almost cut in half. Now, we're going to do a little forecast here in a minute and see what we think it's going to look like in 3 years, depending on sales. But let's just look at what caused cash flow to fall off a cliff. And it's pretty simple from an IVoT perspective. What did sales do? They were down 9%, as I mentioned. So a significant decline in sales. And as a result, a significant decline in their profit margin. They're now making 41% profit on their sportswear compared to 45% a year ago. And that compares to, say, Adidas makes a 50% margin on their business. So they're really falling below par in terms of the entire company. So it's a real problem situation before we even get to tariffs and what we just talked about with the business, with what's going on in the world right now. Before I do any forecasting, look, I listened to or read through the transcript of what the company said at the end of the quarter, what they're doing to try to fix things. And I guess I would say it was a very generic conversation. There was not, I couldn't see in the tea leaves what they were really doing to turn around the situation. The genesis of this problem, as I see it, actually goes back a couple of years. I've been looking at Nike for a while. What they kind of, I think they made a strategic mistake. Nike sells through distribution chains around the world, right? They sell through stores, through big department stores. Very important that those department stores support Nike as a brand. And Nike spends a lot on their positioning in those stores. But then 3 years ago, they said, well, we're making so much more profit when we sell shoes direct, either online or through our own stores, that they started really pushing their direct business, direct to consumer. Well, that sounds great because obviously if you sell a shoe direct for $100 and you sell it through a distributor for 50, it looks a lot better selling it direct. The problem is, their distribution channel is not going to be very happy with them competing against their own distribution channel. And that's, I think, what's kind of come to bear over the last, 12, 24 months. Their distribution channel woke up and started pushing the competitors more heavily. So anyway, this is the tool, and I'll just finish this off and then we can discuss it. But right now it's worth 57 and it's trading 57. Is that not fascinating? I mean, that's, I think, great in a way, a testament to the power of our tools, in the sense that we are literally, what we're saying is the market's basically selling the business for what the current cash flow is worth, on par. It's selling for 57 and the current cash flow stream is worth 57 a share. Now the question is cash flow going to continue to get destroyed, or is it going to improve going forward? Well, I think everything we just talked about for tariffs says, wow, I don't know, but it's not a good environment for these guys. Neither on the sales side, because we're now facing tariffs from other countries being lifted potentially, and people moving away from U.S. product, and also from a cost side, as Andrew pointed out, they make their stuff in Vietnam, and now it's going to cost more, at least for their sales in the U.S. And very quickly, if you look at the level 2 of our tool, and I'm not going to get into this today, but this is something you get access to as our member, the North American business is by far their most valuable business. So now their North American business is going to actually face their own tariffs. It's going to struggle against their own country's tariffs. So I don't know. I mean, what do you think is going to happen in the future? I'd ask you, Andrew, what do you think sales is going to do for the next 3 years on average at Nike? I'm not willing to make a big bet for a turnaround.
Yeah, it's very interesting. I think there's a lot of truth about the distribution channel not pushing their product. At the same time, it was met with a period of what's called brand fatigue for Nike. So Nike was at the helm for the longest time for basketball, for example, but they never really have running shoes. They don't have the throne for the running shoes department. And so that's why you see the new and on-comers like ON, they come to the space. Hoka, like what Ed was referring to, that was really appreciated by the blue-collar working class, especially with the folks that are standing on their feet all day. So there are definitely, newcomers coming in that gives a refreshing look. And the distribution channel, I see it. They take up a lot of real estate. And then Nike is just, it's the same place. But front and centers, I see that distributors, they are pushing other brands. So you're spot on with that. But I do think that they can recover from here. They still have, a great value with their brand. But it's the cycle that the company has to go through.
Well, Ed, I know you have a lot of athlete clients, so I think this segment will probably be interesting to them. And also, Nike has said that they're going to spend a lot more to try to compete, so that's probably good for your clients, because what they're saying is they have to spend more to promote the brand. I kind of honestly question that that's really the issue here. That if Adidas is growing at 18% and they're growing at -10%. There's something beyond brand here that's going on. There's some problem in the company. But
I think they went down a very woke period where they tried to be very, on the cutting edge of everything that was happening socially. And I think that hurt them quite a bit. And you have to look at where they make their biggest profits. And I don't know if they make it in the shoes. I know I have every Nike shirt there is.
It's the shoes. It's the shoe. It's all the shoes. They have other stuff, but it all rides on the shoes. It's like Apple. Apple sells all kinds of stuff. It all rides on the phone. It's actually the truth. I mean, it's nuts. They have all kinds of products, but it's one product that drives the business.
Well, I really appreciate both of you going through this. Emile, that was fantastic, going through the analysis on Nike and coming away with hey, this isn't, we can't make a prediction here because we don't know how earnings are going to be. And Andrew, your market insight is always incredibly valuable. As the IVoT host, I hope that IVoT is seen as it equips you with essential skills in budgeting, investing, credit management, and wealth planning using tools like I-powered financial coach, interactive simulations, and dynamic content. To learn more about IVoT and how we can help you achieve your financial goals, please visit our site, IVoT website address, which is
ivot.academy.
.academy, or
there's also a QR code here. Yeah, I'm sorry. Yeah, to join our IVoT community that you can scan.
Yes. So I really appreciate it, and I look forward to next week when we do this again. So thank you, guys.
Thanks, Ed.
Thank you.